You've got $20,000 saved up, but now comes the big question. What's the plan? For most people, the usual route is leaving it in a savings account where it earns practically nothing. Others might spend it on something fun, flashy, and gone in a few years. But here's where the game changes. That same $20,000, when put to work the right way, has the potential to replace a full-time job. Not through some high-risk, complicated strategy. This comes down to one simple ETF, and the numbers speak for themselves. The Schwab U.S. Dividend Equity ETF, also known as SCHD, has become a standout choice for people wanting solid, long-term passive income. In fact, with a one-time investment and a smart strategy of dividend reinvestment, SCHD can potentially turn $20,000 into a nearly $1 million portfolio that pays over $70,000 a year in dividends. That's more than what most full-time jobs pay today, and the beauty is, it requires zero clocking in and out. Now, before diving into the power of reinvested dividends and compounding growth, it's important to understand what SCHD actually is and why it's gained so much trust from income-focused investors. SCHD is an ETF, or exchange-traded fund, which basically means it's a collection of stocks bundled together. But not just any stocks. SCHD specifically targets high-quality U.S. companies that have a track record of consistently paying dividends. It's like buying a curated basket of some of the most reliable businesses out there. The selection process for these companies is where things get interesting. To even be considered for inclusion in SCHD, a company must have paid consistent dividends for at least 10 years. They also need to have a market cap of at least $500 million and enough liquidity so the fund can buy and sell shares without problems. Once these filters are applied, SCHD goes a step further. It ranks companies based on dividend yield, dividend growth, return on equity, and other financial health indicators. Only the top 50% make the first cut. From there, the fund narrows it down even more, choosing just 100 of the best companies. It makes sure no single company holds more than about 4 to 5% of the total portfolio, and no sector can go above 25%, which keeps things diversified and balanced. The fund also rebalances its holdings every quarter to maintain this structure. That means investors are getting access to a hand-picked, diversified set of dividend-paying giants, all without having to do the heavy lifting themselves. These quarterly rebalances are important because they help SCHD stay aligned with its income and quality focus. If a company's fundamentals weaken or its dividend track record slips, it risks getting dropped from the ETF. This means SCHD constantly adapts to stay sharp and relevant in a changing market. It's a bit like having an automated manager who trims out the underperformers and adds stronger players without emotional bias. Because it rebalances so systematically, the ETF stays true to its long-term objective of sustainable income. And since it doesn't chase trends, SCHD avoids overexposure to overly hyped sectors or short-lived fads. That keeps the fund steady, especially during market corrections. This built-in discipline is part of what makes SCHD so attractive to dividend-focused investors looking for consistency without complication. So, who are the big names inside SCHD's portfolio? The list includes some very familiar and trusted brands. Think of companies like AbbVie, which makes up around 4.71% of the portfolio, Coca-Cola at 4.66%, Amgen at 4.5%, and Cisco Systems at 4.4%. These are industry leaders with long-standing histories, strong financials, and reliable dividend payouts. In the tech world, Cisco is a great example of a company with strong cash flow, which supports its ability to consistently pay out dividends. The healthcare sector also features heavy hitters like Pfizer, known not only for innovation but also for steady dividend performance. All of the companies in SCHD track the Dow Jones U.S. Dividend 100 Index. That means they've proven they can weather market turbulence while continuing to pay their investors. That's a big reason why SCHD is viewed as a dependable source of income. Something else made headlines recently. In October 2024, SCHD underwent a 3-for-1 stock split. This move was a bit unusual for an ETF, since stock splits are more common with individual stocks. After the split, investors received 3 shares for every one they previously owned, and the price per share dropped proportionally. So if one share was priced at $90 before, it became 3 shares at $30 each. While the total value of the investment remained the same, the lower share price made it easier for new investors to get started. It also helped those using dollar cost averaging to buy more shares with smaller amounts of money. The split doesn't change the ETF's performance or fundamentals, but it does improve accessibility for retail investors. More affordability often means more participation, which can enhance trading volume and market interest. This added liquidity can lead to tighter bid-ask spreads, reducing the cost of buying and selling. For long-term holders, the split might feel cosmetic, but it can make a real difference in perception and activity. The move also signals confidence from Schwab, showing they expect continued interest and growth. In a way, it reflects its growing role as a go-to dividend ETF in mainstream investing. Now, the total value of the investment didn't change, but the lower share price makes the ETF more accessible to new and smaller investors. It also opens up opportunities in the options trading market, since lower share prices make it easier to trade contracts that involve 100 shares. Overall, it was a strategic move to increase liquidity and broaden SCHD's investor base. Zooming out to its current performance metrics, SCHD's appeal becomes even more clear. The ETF boasts an incredibly low expense ratio of just 0.06%. That means less of the investment goes toward management fees and more stays invested and working. Compare that to actively managed funds with expense ratios of 1% or more, and SCHD looks like a cost-efficient machine. Low fees are especially important for long-term investors because even small costs compound over time, quietly eating into returns. With more of the dividends and capital appreciation go straight to the investor's bottom line. It's like getting the full potential of the market without constantly losing bits and pieces to high costs. On top of that, SCHD's simplicity adds to its strength. There's no flashy trading, no risky bets, just a focus on consistent quality companies. The fund doesn't chase the hottest tech IPOs or speculative names. Instead, it sticks with proven performers that have been paying and growing their dividends for years. That kind of discipline builds trust and gives investors peace of mind, especially in volatile markets. When the broader market pulls back, SCHD's focus on cash-generating businesses can help cushion the ride. It's that steady, grounded strategy that has earned it such a loyal following. It also has a massive $70.33 billion in assets under management. That's not just a big number. It's a strong signal that investors trust SCHD. This large asset base means the ETF is well diversified, reducing the risk tied to any single company or sector. Add in the high trading volume, around 12 to 14 million shares traded daily, and there's strong liquidity, meaning buying and selling shares is smooth without major price disruptions. So, the big question: can $20,000 really surpass the average full-time job income? The average American salary is around $66,000 a year, or $5,500 per month. That's the target. Hitting that level with passive dividend income might sound unrealistic at first glance, especially from a $20,000 starting point. But with a strategy built around reinvesting dividends, commonly known as DRIP, can make it possible over time. Initially, SCHD's current dividend yield sits around 3.48%. So, a $20,000 investment would bring in about $700 annually, or roughly $60 a month in dividend income. Clearly, that's far from $5,500 per month. But this is where dividend growth and compound reinvestment come into play. Instead of cashing out the dividends, reinvesting them buys more shares, and each of those new shares earns dividends too. That's the compounding effect in action, an income snowball that builds up over time. SCHD has shown an impressive 11.04% dividend growth rate over the past decade. That means those dividend payouts aren't staying flat, they're rising steadily. Now, it won't happen overnight. A $5,500 monthly income requires patience and discipline, but sticking with the DRIP strategy allows the investment to grow exponentially, not linearly. Let's take a look at how the numbers play out over time. With no reinvestment, just collecting dividends and letting the capital sit, the $20,000 would grow, but much more slowly. After 1 year, the portfolio might rise to $22,000 from share price appreciation and dividends. After 10 years, it would grow to around $42,000. In 20 years, about $88,000. By year 30, the portfolio could hit roughly $185,000. Not bad, but not life-changing either. Now contrast that with the DRIP scenario. Reinvesting every dividend payout into more SCHD shares radically changes the outcome. After 1 year, the value might be around the same, about $22,000. But by year 10, the compounding starts kicking in. The portfolio could reach $61,000. After 20 years, it may soar to $212,000. And by year 30, nearly $898,000. That's close to $1 million portfolio from one $20,000 investment. But it's not just about the total value, it's about the income being generated. Without reinvesting dividends, the annual income may start around $700 and crawl up to just $16,000 per year after 30 years. In contrast with DRIP, that income jumps dramatically. Starting at around $1,000 in the early years, the annual dividend income could grow to about $70,000 by year 30. That's almost $6,000 a month, enough to comfortably surpass the average full-time salary in the US. It's all thanks to time, consistency, and compounding. That initial $20,000 doesn't grow on its own. It grows because the dividends feed into more shares, and more shares generate even more dividends. It's a cycle that rewards patience. And the longer the timeline, the more powerful the effect becomes. For those who don't have $20,000 ready to invest today, there's still a path forward. Even small, regular contributions can achieve similar results over time. Just $90 a week into less than the cost of a few dinners out can also snowball into a substantial income-generating portfolio. But for those with that $20,000 ready to go, the opportunity is already in hand. The potential to surpass a full-time job income isn't reserved for Wall Street insiders. It's accessible through smart ETF investing, long-term thinking, and a little patience. SCHD is not just another ETF on the market. It's a well-structured, high-quality income-producing fund backed by some of the most stable and consistent companies in the US. With its low fees, disciplined selection process, high dividend growth rate, and growing investor confidence, SCHD stands out as a powerful tool for building lasting wealth. When combined with a dividend reinvestment strategy, a single $20,000 investment can unlock a future where monthly dividend income comfortably replaces and even surpasses the average full-time job. The key lies in compounding, staying invested, and letting time do its work. If this video helped break it down clearly, don't forget to hit the like button, subscribe for more practical investing strategies, and drop a comment with your thoughts or questions about SCHD.